Hello there. Happy Friday. Welcome to the Open. Let's get to the big stories we're bringing you from our newsroom. Canadian labour market added far more jobs than expected last month. Data from StatsCan indicates that more than 53,000 jobs were added to the economy in November. Economists were expecting a drop of more than 2,000. The increase was driven by part-time work, with healthcare and social assistance leading the gains. The unemployment rate fell to 6.5%, the lowest since July of 2024. Laurentian Bank of Canada reported revenue for its latest quarter that came in below Bay Street expectations, and profit was down 16%. The bank also set aside more money than expected for potentially bad loans. These results follow news this week that National Bank will acquire Laurentian's retail and small businesses, while Fairstone Bank will acquire Laurentian for $1.9 billion. We did see pressure on Netflix in the pre-market. That streaming giant is buying Warner Brothers Discovery in a cash and stock deal valued at $72 billion US. Netflix will pay $27.75 a share and will gain control of Warner's film and TV studios, as well as HBO and HBO Max. The deal is set to close after Warner completes its plan to separate its global networks division into a standalone publicly traded company. This is one of the biggest entertainment deals in history. And there's a look at U.S. futures. It looks like we are going to get a pretty flat market at the open this morning. And let's have a look at how the TSX traded yesterday. Our market has been hitting record high after record high, buoyed this week by strong results from our big banks. Let's see how oil is trading right now amid doubts that any kind of a peace deal will be obtainable in Ukraine. Both sides apparently still digging in. Let's have a look at gold. And you can see gold higher amid widespread expectations the Fed is set to cut interest rates. And let's have a look at the Canadian dollar. Those strong job numbers boosted our currency this morning, because of course they're seen as making it less likely that the Bank of Canada will cut interest rates this month. And finally, Bitcoin, it has been in something of a free fall in recent weeks, down slightly today. Investors have been worried about a potential artificial intelligence bubble, with lots of stocks in that sector running up tremendously this year. However, our guest is not in the bubble camp. We're joined by Matt Cower, president of FSA Valuation Service. Matt, great to see you. Thank you very much for joining us.
Hey, Andy, thanks for having me.
So the massive spending, for example, on data centers and AI equipment, tens, even hundreds of billions of dollars planned over the next few years. You're not worried that companies are overdoing it?
Well, it depends on which companies you're looking at. So like the hardware guys like NVIDIA, TSM, Taiwan Semi, I mean, there's the one that they're spending the money on. Right. So I don't feel that they're in a bubble at the moment. Like, they're making a lot of money. So, for example, NVIDIA just released their quarter not that long ago, 62.5% revenue growth and 61% EBITDA revenue, or EBITDA growth, excuse me, and trading at 34 times. That doesn't sound like a bubble to me. Now, you do see some weakness in some of the software companies, because maybe they're the ones, spending the money and getting a little bit nervous that they're going to overspend. But I just don't overall see a bubble. I see kind of more warranted values. And I know if you look at the stock charts, I would say Yeah, it looks pretty scary, right? If you look at NVIDIA's stock chart for like a 3-year basis, it's up quite a bit, but the fundamentals are there to support it. So that's kind of where I'm at.
What about Google? Google has been in vogue among investors. It turns out, for now anyway, their search business isn't being annihilated by AI. Is that a stock you'd buy right now?
Oh yeah, we love Google. Similar number, well, not quite as much growth, but 15.9% revenue growth in the last quarter, 15.7% EBITDA growth, trading at 19 times. And no, I don't think search is a big problem for them. They have an opportunity in AI as well. Like they have, their own products. It'll only enhance their search. I mean, it's a remarkable company. I wouldn't back off of that one at all, despite the huge run-up. I just don't see it as expensive. And I see the AI as more of an opportunity for Google or Alphabet. Yeah.
There is some evidence, though, emerging that these gains in productivity from AI are going to be slower than people had hoped, and companies are pushing back, apparently, at Microsoft when it comes to paying for AI tools. I know it's very early days. We're just in the Paleolithic era with AI, but is there a risk that expectations have been overdone and that corporate profits won't get the huge boost that people hope for?
Yeah, I think that's very fair to think about those sorts of things, and I think that's possible. We can't grow at these kind of rates forever, even with this type of innovation. But it's not a bubble, right? Like it's just a normal cycle. Maybe you can't quite get the revenue that you thought you were going to get, or maybe you're going to spend a little more than you really would have wanted, or investors would have wanted. But that's kind of just normal business cycles. So I want to stay away from that word bubble. Sure, pullback, maybe overextended, a little less harsh of a word than bubble.
What about Oracle? That stock soared and then fell. Would you be a buyer of Oracle now?
Yeah, so that was kind of an example of if I saw more stories like that, I'd be more in the bubble camp. So CEO came out, Larry Ellison. Nothing against Larry Ellison, nothing against Oracle. I think it's a really good company, and they do have a tremendous opportunity. But it was a really, really kind of overhyped rhetoric that he put out there. So. Oracle stock on that day was up 42%. The stock went to $345. He was saying his projected revenue growth of 77% in 2026, and to get to 144 billion in 4 years. To give it some perspective, their revenue growth previous to that, let me read off of last few years: 42 billion. In 2022, in 2023, 49, 2024, 52 billion, and 2025, 57 billion. So 57 billion was growing around 8%. And now we're supposed to believe, just because of AI, it's going to go to 144 billion in 4 years. And the stock jumped 42% on the day. That's kind of bubbly kind of, talk. Right? If we saw more stories like that, that's one kind of isolated story. I'm not seeing that across the board. So, and nothing against Oracle. I think Oracle's actually quite a good company. I just thought the stock kind of got ahead of itself after that rhetoric, and I'm only seeing that in isolated incidents.
We're tight for time. You are bullish on gold, and Aura Minerals is the name that's caught your eye. Just tell us what the attraction with Aura is, please.
Yeah, so we're mostly like a modeling the financials shop, so we don't get too deep into the weeds on the mineral deposits and things like that, and we just see a tremendous return on capital improving quarter after quarter, just staircasing up, and the value looks to be there. I think I had a multiple on here, was around 10 or 12, I think 10% here of EV/EBITDA. That's our favorite multiple. We don't use PE. And I just think gold overall is bullish. I still think, people are buying gold over U.S. Treasuries. So I still think you got a little bit of runway. And the gold can, by the way, stay at this level. And I think companies are very, very healthy. So their stocks can move up even if gold does not.
Oh, okay. I don't know if we have the chart right now for Aura Minerals, but it's AUGO in U.S. trading.
That's correct.
Thank you very much indeed for joining us, Matt.
Anytime.
Matt Cower, president of FSA Valuation Service. Coming up, Canada posting another month of strong job gains. Investors have been bidding up the Canadian dollar. We'll drill into the data after this. Canada, officially anyway, added more than 53,000 jobs last month. It was the third consecutive month of surprisingly strong gains. And the unemployment rate slid to 6.5%, the lowest since the summer of 2024. We're joined by Travis O'Rourke. He's president at Hayes. Travis, great to see you. You are taking these numbers with a pinch of salt?
Yeah, we're taking a few pinches on this one. I'm a little skeptical. I just can't make the math work. If you look, last month we had 70,000 jobs or so, and we dropped from 7% to 6.9%. Unemployment. And then this month we had 50,000 jobs, and we dropped from 6.9 to 6.5. The math doesn't work unless we've had huge changes to the population mix itself, and I haven't seen that. So a little peculiar in this data. Take some time to dig in. I'm wondering if there's a restatement of some kind in here.
A lot of people, perhaps, I mean, it would suggest left the labor force, but they or stopped looking for work. But there have to be a lot of people.
Yeah, and I think another point to look at, we love to see the youth unemployment finally moving in the right direction. Mm-hmm. To see a full percentage point move after such an atrocious year, that's great. But if we look at where the jobs were added in November, I mean, our primary driver was healthcare and social services. Not exactly where you tend to find youth workers. You see them in food accommodation, in retail work, and in retail, that was the second biggest loss of the month. So there's a lot of confusing data in here. I'm an optimist. Let's take a step back, 6.5. If that's the real number that we do trust, that's fantastic.
Yeah, they're dropping the youth unemployment down to 12.8%, and it got to almost 15% this year. As you say, I mean, it's a tragic story, so many people out of work.
That is. Yeah, it is. And now you've got everyone back in school, retail jobs going down. I don't know. It was last month, we added, I think it was 40,000 retail jobs. So we've kind of canceled them out this month with the drop. Mm-hmm. There was certainly, bullish outlook on the Canadian economy, which is obviously consumer driven, heading into the holiday season when we saw those retail jobs come through in October. So an instant pullback, we don't love to see that. But again, there's more behind this data. We got to dig in, Andy.
Let's have a quick look at the Canadian dollar. Of course, currency traders tend to be knee-jerk type reactors, and everybody trades a security thing, trying to anticipate what will other people do. But we can see the Canadian dollar has jumped. I mean, it makes interest rate cuts less likely on the face of it.
I think if you looked at the data, we add 67,000 part-time jobs. That means we've lost full-time jobs. So if you've got a December 10th rate cut coming, we're losing full-time jobs. The Americans are obviously going to make their cut. It would be very surprising at this point with this data to not see BOC make a move next week.
What do you mean? Do you still think they'll cut?
I do. If we're going to pull back on full-time jobs, like part-time jobs are great, but they're part-time. I don't think this is going to giving the job security that Canadians need.
Well, that's interesting. These figures do not justify, you think, the Bank of Canada staying pat on interest rates.
I think we're going to get a cut. Sorry, Eddie. Yes.
Yeah, you do. Okay.
Yes.
Just let's touch on another topic. Ontario, as of January 1st, will bring in these pay transparency rules.
Yes.
Among other things, when a company with more than 25 workers posts a job, they have to indicate the salary range.
Yes.
Why is that? Why is the government doing that?
I think ultimately it's rooted in a step towards equity. You want to make sure that the person left and right of you, they're earning the same amount of money. And I think that's maybe a big driver from the government is fairness. Mm-hmm. From an employer standpoint, the driver is going to be trust. If you know what you're going to be paid, you're more likely to apply for that job. Now, it's not employers who are angling for this legislation.
No.
This is definitely driven by the government.
Oh, yeah.
But I think greater trust is going to lead to higher applications. Hayes has data. We do a salary guide every year, and 92% greater chance that somebody applies to your job if you've posted how much the job is going to pay. Probably not surprisingly.
Although in some cases we're hearing employers just get this flood of applications, some of them generated by AI.
Oh gosh, I think since, at least the last year since AI has been prevalent in the job hunting market, I've never seen so many candidates that look perfect for a job. You can take a job description and a resume, you can say, make me look like each other, and all of a sudden you've got 40 perfect applicants in your inbox. So yes, between AI agents pumping out applications, resumes created by, Gemini or Copilot, it's a tricky spot to be for a hiring manager right now.
Yeah, and of course, employers faced with this flood of applications sometimes use AI to weed through them.
That's right. Now, January 1st, in Ontario at least, we've got a piece of legislation bolted onto the ESA, which is going to...
What's the Employment
Standards Act.
Okay, yeah.
It's going to force organizations to make it clear if AI is being used to assess or select during the process. Good move in the right direction. It's still a little cloudy, a lot of gray area. What does assess mean? What does select mean? I mean, AI has been used in the process and at some point since the early 2000s. But again, legislation, step in the right direction. We're not where we need to be. AI, step in the right direction, but we're not where we need to be on either of those just yet.
We used to have a guy, a frequent guest on the show, and he ran catering services, so a lot of lower wage jobs. But he said, I don't care about experience or resume or anything. All I care about is attitude.
Yes, honestly, attitude and trust. You care if the person is going to show up to work. You care if they're going to take pride in the work that they do. And you care that they're going to look for the next thing to do and not be told what they have to do next.
Travis, thank you very much.
My pleasure.
Travis O'Rourke, president of Hayes. Coming up, Netflix buying Warner Brothers in a mega deal valued in the tens of billions. That's ahead. Netflix has agreed to buy assets of Warner Brothers in a mega deal valued at more than $70 billion US. Now, officially, this means Netflix wins the bidding war for one of Hollywood's oldest studios. It's also buying HBO as part of the deal. Let's bring in Geetha Ranganathan of Bloomberg Intelligence. Geetha, great to talk to you again. Thanks very much for joining us. Can you remind us now, what is Netflix actually buying? What assets is it buying?
Absolutely. Thank you so much for having me. So Netflix is buying the Warner studio business, which is both TV and film studios, as well as the HBO Max streaming service. The other part of Warner's business, which is its TV network business and includes channels like, CNN, TBS, TNT, all of that is going to be spun into a separate company called Discovery Global, which will be completed by the third quarter of next year. So the assets that Netflix is buying is just really one part, which is the studio and the streaming business.
Right, but Paramount were in the running here, and they're saying that they've been treated very unfairly.
Yes, so Paramount, it was in fact the one who had started this whole thing, and they wanted to get the entire company. Makes a lot of sense for Paramount because they have exposure to exactly the same businesses that Warner Brothers Discovery operates in. They have a TV networks business, they have a studio business, and they have their streaming platform, Paramount Plus, which is a subscale platform and would have really benefited from an HBO Max deal. So they, obviously, they kind of were seen as, the favorite to win the Warner Brothers auction process. So a little bit of a surprise here, but I'm not sure that this whole drama is just over yet. I do think that Paramount very much saw Warner as an existential deal. So I wouldn't be surprised if they come back in with some kind of a counterbid.
CNBC says it spoke to an unnamed White House official who said the White House has deep skepticism about this deal because, Netflix being allowed to buy HBO? What happens to competition? That seems like clearly monopolistic. behavior.
Absolutely. A lot of regulatory, a lot of antitrust red flags here. You are combining the number one streaming service in the world with the number three streaming service. The whole argument, and Netflix is making this point, is how do you define streaming? Is it just these services that you pay for, or should we be including, a platform like YouTube, where people spend hours and hours of their time every day, and you have 2 billion people across the world who are on that platform all the time. So it really comes down now to market definition, because Netflix is really not just competing against Disney or Paramount. It's competing for time with all of these social media platforms.
It is interesting, and we've got this massive battle in streaming globally between YouTube, aka Alphabet, and Netflix. Thanks. That's interesting you put your finger on it, because YouTube it's not just cat videos anymore.
It's not. And that's what, I think Netflix is really playing the long game here. They look at AI. We are, at kind of this precipice of where the whole media ecosystem is going to change with the advent of generational AI. Can drastically reduce the cost of content production, reduce the lower the barriers of entry, so anybody and everybody can really start producing pretty decent content. And I think that is what Netflix kind of sees the writing on the wall, and they wanted to future-proof their business here. So this is really a defensive move by Netflix.
I mean, Variety points out if this deal goes through, it would combine legendary TV franchises like Game of Thrones, The Sopranos, with Netflix's hits such as Wednesday or Bridgerton or Adolescence. So, yeah, just the power of this one organization if they are allowed to buy these assets.
Absolutely. I mean, this is going to be a powerhouse. We've seen Netflix kind of do pretty well in the original space. I mean, you think of a Stranger Things, you think of a K-pop Demon Hunter. Yes, they've had a lot of success, but they haven't had these, this kind of a rich, deep library. And just think of all the things that they can do with it. It's not just putting these shows. It's about mining all of these different properties in many different ways. They've just opened an experience center, getting into like somewhat of a kind of a theme parks business, though on a very small scale. And there's a lot that they can do here going forward.
Yeah. Apparently, the Directors Guild of America has raised questions here about the power that Netflix would get. Geetha, thank you very much indeed. Geetha Ranganathan of Bloomberg Intelligence. Okay, we've got the opening bells coming right at you. Here are the opening bells on Wall Street. At the NASDAQ, it's McKinley Acquisition Corporation ringing the bell. At the NYSE, it's executives and guests of, quote, How to Make a Few More $1 Billion by Brad Jacobs to celebrate the book launch. To honor the occasion, Brad Jacobs, the author himself, ringing the opening bell. TSX trading as well. Our market's open. Let's get to it. And let's check in on the equity markets as we get going on this Friday. And there is the TSX slipping slightly in opening trading, but investors have nothing to complain about this year. Our composite index hit a record high yesterday, so we're just slightly down from that. And let's have a look at the old US markets, the S&P 500. Investors digesting that incredible acquisition of the streaming assets of Warner by Netflix in a deal including debt and stuff valued at more than $80 billion. The S&P is higher, still slightly down from its record on October 28th. A couple of stocks of interest here in Canada. Laurentian Bank, which is about to be dismembered, bought by a big private lender, and National Bank of Canada, posting earnings that missed expectations, but the stock trading on that takeover deal. EQB, lots of to and fro in financial services this week. EQB picking up the PC Financial business from Loblaws. The stock jumped yesterday on the prospect of vastly enlarged franchise, but you can see the shares not doing much of anything right now. And RBC upgrading Extendicare, this senior accommodation giant, moving the price target up by $10 to $25. Previously, RBC was at hold on this name. There's RBC, but let's have a quick look at Extendicare, EXE. They're upgrading that name after the acquisition of CBI Home Health, and that deal valued at almost $600 million. Of course, it gives them diversification and even vertical integration in the senior health market. Let's get more on stocks on the move. We're going south of the border, and we're joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Update us on, Jeff, hi, update us on Netflix, please.
Yeah, Netflix is one of the worst performing stocks in the S&P 500 this morning, and the company that is buying, Warner Brothers Discovery, is one of the top performing stocks. I guess that's what happens when you use your own shares to buy another company. This deal is a combination of cash and shares, total enterprise value of almost $83 billion. So quite a blockbuster, if I may use the word, this morning of a deal, and quite an enormous one, as I mentioned. Netflix does think that it's going to be able to see positive earnings per share resulting from this deal as early as year 2. They also expect to see about $2 billion to $3 billion in annual cost savings as a result. But this is a huge deal, and still is going to take a little bit of time to digest. That may be why we're seeing a little bit of weakness in the shares this morning. On the Netflix side, anyway, Warner Brothers Discovery, those shareholders might be a little bit pleased with what they're getting so far.
Jeff, do you have a favorite streaming show, one on Netflix or Apple or Prime?
You know, I've been watching some on Crave, Letterkenny and Shoresy recently.
Okay, good stuff. Good Canadian content there. Hewlett-Packard Enterprise, what's going on there? A disappointing forecast?
Disappointing forecast, and this is the worst performing stock in the S&P 500 so far today. Definitely one worth watching. And this is something that we have seen from a handful of the other names that are involved kind of in this AI infrastructure build-out space. The problem is the forecast for what they intend to build and some of the deals that they had struck to supply servers are actually going to be delayed until next year. In one case, there's a server or a data center in Europe that isn't ready yet. And so we have seen a little bit, and we've seen some stocks sell off as a result of this, where you have had kind of the AI infrastructure spend priced into a stock, and then the actual delivery of some of this has been delayed, and that has caused the stock to sell off. That is what we're seeing so far today with HPE, and it's definitely one worth watching, especially if this does, if we do see this showing up in other stocks over the course of next year.
Sorry, Jeff. And finally, Cooper companies, they're active in contact lenses, and that stock was up in the pre-market.
This is the top performing stock in the S&P 500 so far today. And the exact opposite reason. They had a fairly inline quarter, nothing to get excited about here. But the outlook here is much better than expected for 2026. A number of folks on Wall Street very pleased to see guidance raised higher, and Needham came out this morning and said this was a very solid end to an otherwise choppy year for Cooper. So definitely a big move higher by them this morning, and quite a remarkable outlook for 2026 growth.
Thank you very much, Jeff. I'm not sure, Control Room, could we put up a chart for Cineplex, CJX, or CGX, I think, CGX, because obviously this, if Netflix succeeds in buying the Warner movie business, there'll be the question of, will they be even interested in having these shows in theaters? Now, Netflix, according to Variety.com, is insisting we've no opposition to movies in theaters. We do expect to release Warner Brothers films theatrically. However, they are talking about the windows will evolve to be much more consumer friendly. And I wonder, is the implication there that they would keep movies for a shorter time in the movie theaters before they go to streaming? And that's interesting. The company's saying long exclusive windows, we don't really think are that consumer friendly. So that's interesting. The movie theaters, of course, too, or at least some of them have expressed concern about Netflix buying Warner because it would give it such a lock on the entertainment business. Coming up, we're going to get more on this Warner sale. It is one of the biggest entertainment deals in history. Showbiz shaken up by that mega deal in which Netflix is buying Warner's streaming and movie studio business. Our guest says this deal could get a bit messy. We're joined by Brian Belsky, CEO and Chief Investment Officer at Humulus Investment Strategies. Brian, thanks very much indeed for joining us. Happy Friday. Everybody knows about movies and streaming, and so the regulators may have an objection to Netflix getting so much power, do you think?
There might be. Good morning, Canada. There might be. Paramount wanted this content for a number of different reasons, so there could be some issues there. I would also think, too, that this follows through with what our broader theme for the communication services sector has been for 10 years, which is the 3 C's, which would be cash, content, and consolidation. Mm-hmm. We think there's more coming. We think this is all about buying the brand of Warner Brothers and really their great HBO brand and some of their other series, whether or not that's Batman and those types of things, and maybe Netflix can monetize it a little bit better than Warner Brothers has when this spin out. Remember, this company was spun out from AT&T. Mm-hmm. So I think that there's going to be probably some noise around this. Paramount wanted the whole thing, and so there could be some disruption. But at the end of the day, we're happy because we own Warner Brothers. And we also own Netflix, but I think the Netflix part of it, I don't care if the stock is down today. We don't manage money for a day. We think from the longer term perspective, the trend of accumulating this type of great content makes a lot of sense for Netflix.
The stock's slipping a bit, but as you say, just one day. Maybe we could put up a 5 or a 10-year chart for Netflix because they just seem to go from strength to strength, a global franchise, to put it mildly.
Well, you and I are probably old enough to remember the late 1970s, and I like to explain how important HBO was in the late 1970s, early 80s. I mean, that was the channel to have. That's what they had, the content. They had movies faster. Mm-hmm. Remember, cable was a big deal. And if you also remember, too, stand-up comedy really was born in terms of the new age with respect to television in the late 70s, early 80s on HBO. So now you fast forward a 3 decades, and Netflix now is the place for stand-up comedy and the like. So there is some correlations there that I think are very, very interesting. Mm-hmm. And I do think as you look at these other studios, whether or not it's Sony or Amazon and even Paramount, Comcast is probably in play in terms of part of what they're doing. Remember, the streaming companies, these big companies with streaming services, really difficult to monetize. Apple's done a pretty good job. Netflix has done a pretty good job. Disney's done a pretty good job. But aside from that, it's a tough sled. And that's why you saw the Paramount Skydance merger. Mm-hmm. And so I think there's more coming. And on this particular buyout here of Netflix, I think it could be noisy.
You could be noisy in terms of anti-monopoly concerns, Brian?
I don't think it's so much that. I think the media is making too much play out of President Trump and the administration with respect to the conservative ties of Paramount and Mr. Ellison at Oracle. I think that's not. I think that's the anti part of that is not a big part of it. I think there's going to be some other companies coming in. Mm-hmm. I think that there could be this could spur other mergers and activity. The good thing about this particular consolidation, and from our lens, is we like the fact that they're using cash. We like consolidation with cash. If it was the majority of stock, we wouldn't like it, but we like the notion of companies being bought with a majority of cash.
Brian, what else? We're seeing more and more speculation that the AI business is a bubble, or at least the valuations on these stocks. And apparently some evidence is emerging that companies are having a tough time initially getting much more productivity out of AI tools.
I think it's early on. I love the speculation with respect to AI. I think you need these bearish prognostications out there. I think the CapEx boom is just beginning. But what we're seeing is delineation and dispersion within companies, which has been our broader theme with respect to our investment strategy for several years. So we're seeing things in performance with respect to not only fundamentals, but price performance, Andrew, spread out. And that's very, very good. So the market in AI and / tech has been excessively what I would call resilient with respect to some of the pullback that we saw in November heading into December. Part of that might be kind of just end of the month profit taking in November. But now, if you take a look at the majority of institutional accounts and hedge funds, they're massively underperforming. And so I do think once we start to have kind of a settling in here, which we already have here the first week of December, I think we could have a very strong couple of weeks. We don't like to make short-term calls with respect to running money or our investment strategy, but I think we could have a couple very strong weeks heading into the Christmas season where portfolios will be lifted higher, especially given the fact that, again, a lot of these institutional accounts are underperforming.
That's institutions have underperformed partly because they weren't riding these big tech names higher?
Yes, that is correct. They were late, or they picked the wrong tech names, and they've been focusing more on the negativity, and they got too short and sold too soon. So again, we're not short-term investors, we're longer-term investors. We take 18 to 24 months minimum when we take a look at a company. And so that's we've been very blessed and fortunate to have great performance in our portfolios because of that, because we stick with our process and our discipline.
Brian, thank you very much indeed.
Thank you.
Brian Belsky, CEO and Chief Investment Officer at Humulus Investment Strategies. As the FIFA World Cup draw gets underway in Washington, the Prime Minister, US President Donald Trump, and Mexico's leader are set to meet on the sidelines. More ahead. As the FIFA World Cup draw gets underway in Washington, North America's leaders are expected to play a little soccer diplomacy in the capital region. We have the leaders of Canada, the US, and Mexico gathering, and they're set to hold separate meetings over the future of their country's trade agreement. Let's get more on what's at stake here. We're joined by CTV's Jeremy Sharon. Jeremy, thanks very much indeed for joining us. So the Prime Minister, Mr. Carney, is going to be meeting with his US and Mexican counterparts. What do we know so far?
Yeah, exactly, Andy. Look, it won't be just a highly anticipated result for the FIFA draw, but a highly anticipated meeting between the world leaders. U.S. President Donald Trump will meet with Prime Minister Mark Carney today in an official capacity on the sidelines of that FIFA event in Washington at the Kennedy Center. This will be the first time the Prime Minister and Donald Trump meet officially in person since October, when Donald Trump ended trade talks between the two countries over that anti-tariff ad that Ontario put out that featured Ronald Reagan. Donald Trump hated it. He was upset and decided to end negotiations over that ad. Now, since then, we know Donald Trump and Prime Minister Carney have been in touch. The Prime Minister recently told the reporters here in Ottawa that he was in touch with the President towards the end of November, but that it was not a newsworthy conversation. So this certainly will be newsworthy today, Andy, in the fact that the Prime Minister and the President will meet. But as you've touched on, the Prime Minister is also going to have a separate meeting with Mexican President Claudia Sheinbaum at a time when, relations between Canada and Mexico are very important as well. The Prime Minister was there in September. They're looking to bolster their relationship in the face of this trade war with Donald Trump. And so there's a lot on the line today, and many will be watching to see what comes of this meeting with Trump. And is Carney able to, through these talks, reignite negotiations with the U.S. when it comes to tariffs and trade? The steel and aluminum sector, the softwood lumber sector, the auto sector will all be watching with bated breath to see what comes of this and whether or not it can result in the resumption of negotiations.
And can you just clarify us, Jeremy? Apparently yesterday the story was they wouldn't be talking trade, but they might actually discuss it?
Yeah, it's unclear at this point. We don't know definitively. There were some reports yesterday that they would not be talking trade, but hard to imagine a world where the two leaders, meet in an official capacity and don't talk about, the ongoing trade relationship at all. But, to be clear, we don't know definitively what is going to be discussed. Hopefully we'll learn a little more today. Still unclear whether the Prime Minister will, hold any kind of press conference or speak to the media at any point after this meeting. We'll likely hear at some point from the President when he passes by the press corp or whatever. He may stop at some point. But yeah, I think that certainly that will be the big question. What was discussed and how much trade was discussed? And will this result in more trade being discussed in an official capacity through negotiations once again?
Thanks very much, Jeremy. Jeremy Sharon, our colleague at CTV News. Coming up, we'll check out some early market movers on the TSX. AI boom has fueled some stocks to massive valuations, but it has also taken the spotlight off a number of software businesses. BNN Bloomberg contributor John Ehrlichman joins us with more. And John hosts the Ticker Take YouTube channel. John, these are some possibly undervalued stocks you're highlighting today.
That's kind of the thesis here, Andy, because I know we've talked about the AI bubble and whether or not that's going to end poorly for people. What we've talked a little bit less about is whether or not the AI boom has overshadowed other parts of technology. Now, valuations in a lot of the traditional AI companies that we've been talking about have soared, to your point. I was just looking at the Magnificent Seven. They've seen their total market cap grow by more than $3.5 trillion this year. It's kind of mind-blowing. But then you've got a group like software as an example. Now, just to be clear, AI is basically software. Don't take my word for it. I mean, Jensen Huang of NVIDIA has said as much. But if companies aren't AI first and they're in software, a couple of things have happened this year. Either they just haven't had the same amount of attention in the market, a little less shine, or there's been a fear that AI would actually disrupt their tried and true software businesses, and investors got skittish. And we even saw that in the market this week with Salesforce, trying to prove its AI worth to the market. So I think it's a theme we're going to be watching for a while here.
Give us a couple of the companies that pop up on your screen here.
Well, just as an example, on Ticker Take this week, we spoke with an investor, Zach Hartley, who highlighted a few software companies that might be under the radar. First of all, Adobe. Now, Adobe is a great example of a company that's had a huge move over the last decade. But this year, because of the AI tools that can make all sorts of cool creative stuff, people have been freaked out about whether its subscription business would be at risk. Well, a lot of the analysts say, actually, Adobe can use more AI tools to keep that subscription business sticky, and they're still on pace for some good profit growth. Another example would be LegalZoom. So here's a company that, if you don't need a big law firm for some M&A deal, you just need sort of, a little help on the side for your business or just for yourself. They tend to benefit from that. And if you're a believer that lawyers could see those high fees harder to convince people to pay in the AI era, you might still need somebody to dot the I's and cross the T's, and that could benefit LegalZoom, which again, when you look at the analyst expectations, has potential profit growth. A third one would be Toast, which is not unlike Lightspeed, the point-of-sale software company. This one focuses on the restaurant business, and again, they might be able to implement more AI tools to grow their profits. If they've got a rogue, employee, Andy Bell, who is stealing sandwiches at the diner, using more AI into their operational systems might make the owner of the business more happy with their Toast software, just to take a random example.
I always get an office intern to take sandwiches for me, John.
Okay.
Yeah,
Right.
You'll never catch me close to a job like that.
Okay.
John, we better leave it there. Thanks very much. Ticker Take host John Ehrlichman. You can read about his possibly overlooked software stocks on our website, bnnbloomberg.ca. Let's check out some stocks on the move in Toronto. Orla Mining has seen some selling today. OLA is the ticker symbol, I believe. Fairfax Financial, through subsidiaries, selling 25 million shares at north of $17 a share for aggregate proceeds of about $441 million. So you can see Orla Mining, which has had an incredible run in common with many other gold stocks, losing a little bit of altitude today. We're seeing a bit of selling, nothing dramatic, in uranium names today. And I haven't seen any particularly bad news about uranium. And of course, these stocks too have had a huge run. There's Cameco down from its highs, but still up more than 50% in the past year. And maybe we could put up DML because Denison Mines is pressing ahead with its Wheeler River uranium mining project, and it has won Métis Nation Saskatchewan approval for that process. You can see that stock down as well. NextGen Energy down as well. And let's have a quick look at some of the energy stocks here. Canadian Natural Resources. Always fascinating that its yield now higher than some of the big banks. It offers, obviously, CNQ offers a play on oil and gas, but look at the shares moving higher today, despite oil prices still mired below $60 US. We'll be right back. Welcome to the second hour of The Open. Let's check out some stories that we're bringing you from our newsroom. Canadian labour market added far more jobs than expected last month. Data from StatsCan indicates that more than 53,000 jobs were added to the economy in November. Economists were expecting a drop of more than 2,000. The increase was driven by part-time work, with healthcare and social assistance leading the gains. The unemployment rate slid to 6.5%, the lowest since the summer of 2024. Laurentian Bank of Canada reported revenue in its latest quarter that came in below Bay Street expectations, and profit was down 16%. The bank also set aside more money than expected for potentially bad loans. Laurentian is set to be bought in a deal in which National Bank will acquire its retail and small business franchises, while Fairstone Bank will acquire Laurentian itself for $1.9 billion. West Fraser Timber says it will indefinitely shut down its oriented strand board mill in High Level, Alberta, effective spring of next year. The forest giant says the move is due to a significant weakening in demand. Nearly 200 employees will be affected. West Fraser also says the idling of one production line at its Georgia facility will continue indefinitely. And the TSX pushing further into record territory today, a new high for our benchmark index. Let's see how the US markets are doing. And you can see they too are pushing higher. Check in now on oil, which has really been in a narrow range for quite a few weeks, getting its snout above $60 at benchmark today, but it's still down more than 12% in the past 12 months. And let's have a look at gold, because gold showing signs of strength today, up almost 1%, moving higher to those record levels that we saw a few weeks ago. And finally, let's have a look at the Canadian dollar. It jumped after those strong job numbers, and it's still trading above 72 cents US. Gold has had a record-breaking run this year, and silver has surprised the investors with a significant leap. Let's get more and an outlook for 2026 from David McElvany, Portfolio Manager and CEO, McElvany Financial Companies. David, thanks very much indeed for joining us. We know why gold is up, or the reasons that were given, but what about silver? Why has silver taken off?
Well, silver is at the confluence of industrial demand picking up. At the same time, investors are paying attention on a global basis to inflation. We had a tremendous impact in the market from Indian demand this year. I think a part of that is as gold gets to higher levels, there's almost a substitutionary effect where people look at the affordability of silver, the accessibility of silver, and as a precious metal, it's a decent or reasonable substitute. So demand there has been phenomenal. We continue to see huge demand on the industrial side, particularly in solar. And that's something that was not a factor 5 years ago. In the 5-year period where industrial demand for silver has picked up considerably, we're also talking about being in or operating in a supply deficit through those 5 years. So I think we are at that sort of inflection point where the market's recognizing supply deficits. And with the increase in industrial demand, now just at the margins, you get investors to step in and you realize just how small the market is with an explosive move up 100% this year.
Silver for a long time languished relative to gold. What about the famous ratio between gold and silver? Is silver still relatively cheap by that measure?
Absolutely. It is very cheap relative to gold. In the context of a precious metals bull market, typically you'll see the ratio trade between 40 and 65. So the fact that most of this year we've been stuck around 80, 85 has put it in the value range for sure. Now today we're closer to 73 to 1, and it is beginning to break out. So normal patterns, normal behavior, but it does imply significantly higher prices just to get into a normal trading range. The gold-silver ratio is something that certainly suggests we could see in short order within the next 6 months, certainly within the next 12 months, a $65 to $80 price per ounce.
You say that bullion can be a good holding here. Would you do it with physical gold held securely, or would you be inclined to buy one of these ETFs that say we're backed by physical precious metals?
I think both are reasonable options. It just depends on what the motivation of the investor is. If it's for fun and profits and a fast trade, I think the ETF liquidity is superior. If you're looking at something that lacks any counterparty exposure, then I think that's where bullion physically held makes all the sense in the world. It doesn't appear that people care too much about counterparty risk today, although we have a growing bond bubble on a global basis. If you're looking at government bonds, not a lot of indications of stress in the bond market as of yet, unless you were to see gold as perhaps an indicator, a canary in the coal mine, so to say, for ultimately unsustainable fiscal positions, not just in the U.S., but in many of the G7.
That's interesting. You think government bonds, there is a cloud over them now?
Well, they don't trade like there's a cloud over them, but I do think the unsustainable nature of our expenditures, I can speak to the U.S. Certainly more clearly. You know, we've never spent $2 trillion a year in excess without there being a significant economic issue in play. We could look at the pandemic. We could look at significant recessions or being in wartime. Then and only then do we spend this kind of money. And so to do so without sort of emergency cause suggests that there is reasons to be concerned in the market. Currently, our interest on the national debt exceeds $1 trillion and is marching towards 20, even 25% of all tax revenue for 2026. So I would say that that's in the category of unsustainable.
One stock you've suggested to us in the past has been Pan American Silver, PAAS. Is that a name you still favor?
We do. It's difficult to look in the silver space for very high quality names. And I think it's actually easier in the gold space to find the best management and superior business models. Franco-Nevada and the royalty names are certainly the best in terms of a business model. But if you're looking for superior management, Agnico Eagle is still at the top of our list. Pan American makes the cut. But there are very few silver plays, pure play silver plays, that have great resources, great geographies, and great management, which is one of the reasons why we've leaned into Pan American.
What about Barrick? Have you been following that saga, the potential spin-off of their North American operations? Do you think that will improve sentiment when it comes to ABX?
Yeah, it is a portfolio holding. We've owned it as essentially a turnaround story where they needed to get past the conflict in Mali with the government there. They seem to have resolved most of that. I think the board is recognizing that there is a differentiation between geographies, and to be in Tier 1 does matter. And so to carve out their Tier 1 assets and separate them out from Tier 2, 3, and 4, I think we'll have significant uplift, particularly for the listed North American assets.
And finally, what would deter you from buying gold? What could go wrong here?
What would deter me from gold is it's expensive. You know, you look at 4,200. We think that it can trade to $5,000-$6,000 next year. Longer term, even 8,000. The thing is, you know, a move of 60%, it certainly gives investors pause to say, you know, do I really want to step in near all-time highs? I would just remind people to look and count M2 money supply and the growth in money supply in recent years and recent decades. Realize that the value of the currency itself is far less. That's obscured somewhat when you look at the dollar index, where you're weighting strength against these other currencies, whether it's the yen or the euro. So what would give me pause is that it's expensive. Mm-hmm. What would probably release me from that resistance or constraint is that it's a very under-owned asset. If you look at institutional managers, if you look at retail investors, it represents a very small percentage of their portfolio, if anything at all. And so I think expensive, yes, but still very, very under-owned. I think the adoption cycle is just beginning. With Mike Wilson at Morgan Stanley, suggests this significant model shift from a 60-40 portfolio, 60% equities, 40% bonds, to what he views as more appropriate in this environment. And it goes back to my comments on the bond market, where now he suggests 60-20, 20% bonds, 20% gold. Why would you substitute half of your bond portfolio with gold if there wasn't significant structural issues within the bond market? You have to be recognized, clearly. But watch the MOVE index, and I think you'll have an indication for when stress is emerging there. So we see a lot of folks moving into gold, maybe on a first mover basis, anticipating these unsustainable bond market conditions.
Thank you very much indeed for joining us, David. David McElvaney. Lots more market action when we come back. The big event in the market today, Netflix going ahead with a bold deal to acquire the streaming and broadcast assets of Warner. Let's get more from Jonathan Corpina, Senior Managing Partner at Meridian Equity Partners. Jonathan, always great to talk to you. What do you think? There's a lot of talk that Netflix will face political opposition with this deal. They'll have such a grip on the show business industry.
Yeah, I mean, Hollywood is slowly becoming, few players in a big town. The antitrust issues that they are going to face moving forward on this, both domestic and in Europe, is going to be a pretty strong headwind here. Yes, this is a overall positive for the markets, right? We like to see M&A activity. We usually start to see a few big deals towards the end of the year as books start to close. This is a major deal. Netflix is normally a build-it-yourself company, right? Think about where they started and where they've gotten to today. And the fact that they have decided to make this large acquisition is quite outside of their comfort zone. So I think overall, the concepts, the ideas are very good. But again, going into this, they were fully aware of the fact that they're going to certainly hit some headwinds from the antitrust monopoly issues that will certainly be brought to the forefront. This is going to take quite some time to get this deal done. I think we're going to start to see a lot of volatility in both stock prices if there is this continuing inclination that this deal has a possibility of not getting done. So, it's going to be fun to watch this thing play out.
So we're awaiting that Fed decision this coming Wednesday. Your gut feel, is it going to be a cut?
All things are indicating that we are going to see a 25 basis point cut. But again, it comes down to every single meeting. It's not really what they're doing. It's what they say afterwards, what the Q&A is, what indications we might get from them. If you go back 2 weeks, there was some rumblings about maybe they're going to pause. We did have a sell-off on the market, some comments that came out of some Fed chairs and some economic data. Turn that around rather quickly. We've seen the market rebound since then. The market is pricing in this 25 basis points. But again, it's going to be the rhetoric. What are they going to say about moving forward? Is it the same script? Is there a couple of words, a couple of sentences that are going to shift? So I think the market's feeling, we're seeing the activity that we're seeing now due to economic data, due to M&A activity, due to the pricing into the Fed. But what happens after that? And then after that, we kind of continue into this holiday season. Less activity, less volume, could add for a little more volatility. We'll see if we see that Santa Claus rally or if that's been priced in already.
So as we approach the end of the trading year, do you think there'll be any inclination among portfolio managers to say, oh, I've made a lot of money on some of these tech stocks. I'm going to lighten up. I'm going to book some profits?
I think we might have seen some of that already. We might see a little bit of it, but I don't think we're going to see, quote unquote, booking profits. I think we're going to see this market stay at these levels where we are for the next 2.5 weeks to make sure that the end of the month, end of the quarter, end of the year returns stay somewhat intact. But keep that in mind as we get into 2026. If we continue to see these higher valuations, we're going to continue to have these conversations of what's going to make this market sell off, where's the fear, where's the catalyst. We might start to see some profit taking coming off the table. But when that occurs, these portfolio managers aren't going to sit on cash for a long time. They're going to have to find other areas or stocks to start implementing this. So when we see volatility in the market, like we saw 2 weeks ago, I think you saw an opportunity there for individuals and portfolio managers to get some cheap prices in a very short period of time.
One stock you're watching is the beauty player Ulta. Does that stock look reasonably priced?
It does. Listen, I'm married and I have 3 daughters, so I've seen plenty of Ulta receipts come across my desk for the past few years. So this one to me is not surprising. The focus on health and beauty continues as investors, as Main Street purchasers still fight inflationary fears. They still fight discretionary spending. But it seems at this point, investors are clearly and purchasers are clearly focusing on this area and committed to this area. I think some headwinds that Ultra might find is that as this cosmetic area, as this health and beauty area continues to grow, you're going to get some of the big boxers, the Walmarts, the Amazons of the world, pour significant amount of money into investments into this to try to catch up and get on the radar screen there. So there certainly might be some headwinds there for Ulta, but for the time being, with their forecast moving forward, it seems like there's potential upside there.
Jonathan, we better leave it there. Thank you very much indeed for joining us. Have a great weekend.
You too, sir. Thank you.
Jonathan Corpina, Senior Managing Partner at Meridian Equity Partners. Coming up, the last of the Canadian banks reporting today. We'll get a roundup of this earnings season for our mighty lenders. That's ahead. Been a busy week. All of the major Canadian banks reporting their results. Earlier, Alan Small, Senior Investment Advisor at the Alan Small Financial Group, joined us to give us his bank earnings report card.
I think coming in, I had said to many that I was expecting a pretty good report card. Some banks set aside a little bit more money for some potential bad loans. But overall, the capital markets, the wealth management division, business outside of Canada, extremely well. And that was more than enough to offset any extra money that maybe some of the banks had set aside for potential bad debt. So to me, the banks strong. I think picking up from where the banks to the south left off, U.S. banks, some of the big banks down there, Citi, Bank of America, JP Morgan also reported fantastic earnings. So you kind of had to figure that our banks would follow suit, and they did. The question I have now is, what do you do with the banks, right?
Well, that's what I was going to say. Are they priced to perfection?
I think so, or pretty close. You're looking at these banks now. You have, for example, Royal Bank trading at 16 times. You have TD Bank 14.5 times. Scotia even, which used to be the cheapest one, 12 times earnings, forward earnings. So to me, how much further can these banks run? Banks has been a great place for Canadian investors to invest over the long term. You pick up a pretty good dividend and you have growth over time. But now that dividend has shrunk a lot. Some of the banks, most of the banks actually increased their dividend this go round. So now Royal is just paying about a 3% dividend. TD Bank just over 3%. The largest dividend now is still Scotia of the main five, just under 5%. I guess about a year ago, that would have been over 6%. So the banks have had a great run. It's been a great place to invest over the last, let's call it 12, 24 months. But I think it's becoming more difficult. I think they're becoming more expensive. And I was actually hoping to see a bit of a sell the news phenomenon, but we actually got some more buying over the last little while. And a lot of those banks now are trading at all-time highs or at least 52-week highs today. So tough to buy new today. I think if you own them, you're probably going to hold on to them. But to get more, put more money to work there, it is difficult.
So what's it going to take then for the banks to be attractive again?
Yeah, well, I'd like to see...
Not that they're unattractive, but...
I'd like to see a bit of a pullback at some point, buy the dip if we get one. But we're going to have to see, right? I think interest rates, if they continue to fall in the U.S., it looks like they'll cut rates again coming up on the 10th. Will we cut rates here in our country? I think there's that happy middle, right? Happy medium. You cut a little bit to make loans a little bit more affordable, but you don't want to cut too much. And if they do cut too much, then the banks can't charge enough for the loans they provide. So you want to have, not too hot, not too cold, just right kind of situation, which I think we're in, and we're going towards maybe with a couple more cuts. I think the banks will be just right. So we'll have to see what they report. If they can continue to increase their earnings, I know a lot of them are trying to increase business outside of Canada, like a CIBC.
Yep.
I think that has definitely helped them. If we see profits and earnings go higher, obviously the bank, the shares become cheaper. So buy on the dip or perhaps look for some more strength down the road.
Okay, and the two sales this week, what did you think of them? Laurentian on Monday and PC Financial.
I think Laurentian was inevitable. They've been up for sale for quite some time. They finally got a deal done. We saw the earnings that came out just today.
Yep.
Laurentian, soft. Of course, they've been looking to be sold for quite some time. EQB, formerly Equitable Group, a name that I own for many investors, down from where it used to trade, well over $100 a share, got into the high 80s. Yesterday, nice to see up 13%.
Yep.
Anytime that, I guess now the seventh largest bank in our country can gain some more assets, some more customers, it's a win for them, and I think that's why they did that deal.
And do you see any more? Are there any more deals of that scope, or is it mostly just kind of hunt and peck now?
Yeah, I think it's been hunt and peck. Pick some, for a while now. Tough to compete in this country with the big five or big six if you count National Bank. They pretty much dominate. Unlike in the U.S. where they have a few thousand banks, we have not nowhere near what I think we're at 30 or 40 ourselves, but really five dominate in all markets. So tough to see someone like an EQB rise, but they've done a great job. CEO's done a great job, in my opinion. And it's a name, if you're looking for that online bank, I guess they would be the one that is the most online and growing, hopefully, quickly to compete against some of the larger, the top five.
All right, we're almost out of time for this, but just overall on the market, thoughts on how the week looked, how it's shaping up?
Well, I think right now,
we head into the final month.
Yeah, I think investors are going to find it difficult a little bit. There's not really much of a catalyst going into the last 3 weeks of the year. I think seasonality will probably be your best friend. Normally, December is a good time for investors. We get that hopeful Santa Claus rally, and hopefully we see a cut by the Fed on the 10th, and we're going to get, I guess, some jobs numbers today out of Canada, but we're also going to get some inflation data. Even though it's old in September, PCE is coming out today in the U.S. We'll see what that says. But overall, I think a lack of catalysts, perhaps investors may just be on the sideline. So I'm looking for a bit of a flat market over the last 3 weeks.
We were joined earlier by Alan Small. Coming up, Warren Buffett is retiring at the end of the year. We'll have more on his legacy when we come back. Warren Buffett is retiring at the end of the year. This week's Bloomberg Doc dives into how the Oracle of Omaha changed investing and what's next for the company he built.
If investors had a Hall of Fame, Warren Buffett would occupy his own wing.
People from all over the planet look up to him, read his biography, hop on a plane to go see him talk.
He took a failing textile mill and turned it into a $1 trillion conglomerate. It has insurance companies, Dairy Queen, railroads, and energy businesses.
For decades, Buffett's investment savvy has led Berkshire Hathaway to beat benchmarks.
One of the biggest asset managers today, which is Vanguard, the entire philosophy is no one's really going to be able to beat the market, so you might as well not even try. Well, okay, no one besides Warren Buffett.
If you look at the total returns, Berkshire blows the S&P 500 away.
The legendary investor Warren Buffett.
So when the 95-year-old announced he would retire at the end of 2025,
Greg should become the chief executive officer of the company.
It marked the end of an era at Berkshire Hathaway and left everyone with one massive question. Warren Buffett is one of the richest people on Earth, but his lifestyle doesn't exactly scream it.
He lives in Omaha. He lives in the same house he's lived for many, many years.
Holiday sausage muffin with...
He goes to McDonald's in Omaha. A lot of people around the city know him.
He's paid just $100K and has been paid that amount for years. That's very refreshing when you think about the landscape today.
So what's the backstory? Well, Buffett's childhood fascination with money led him to Columbia Business School, where he studied under a renowned educator.
Benjamin Graham was a financial analyst considered to be the father of value investing.
Value investing is really this idea that you're not just betting on some fluke in the market. You're really looking at what you think it's worth versus what the value that the market is providing. Ideally, you want to buy a company that you think is undervalued and that it's going to rise in many years. But that requires a lot of due diligence. That requires you to make sure you actually understand how the business works.
I'm not buying them because I think they're going to go up next year. I'm buying them because I think they'll be worth quite a bit more money 10 years or 20 years from now.
Investment after investment, that strategy came to define Berkshire Hathaway. But let's see it in action by focusing on just one.
American Express is an investment that he's had for decades, and when he bought it, the stock price was a bit down because of a scandal at the time, but he saw the value of Americans that kept swiping those Amex all over the place.
That was back in the 1960s. But look at this. Berkshire's current Amex holding was largely assembled here in the 1990s for about $1.3 billion. Since then, Buffett's largely left that core stake intact. But Amex's market value has soared in the years since, making his 22% holding worth tens of billions of dollars.
He was interested because the company has a good moat. By moat, he means some competitive advantage against other companies in the business.
For Amex, that moat is a mix of its premium brand, affluent cardholders, and a network built around their spending power.
Another kind of edge you can have over your competitors is regulation.
Think about the energy business. A lot of those have advantages that a competitor couldn't come in and easily take the market share. That's really helped his business sustain itself. He's built up companies that are not so easy to replicate.
But perhaps the most underappreciated force behind Berkshire's rise is its insurance business.
They're not always the companies that are going to draw the hype from stockholders, but it's actually been a force that's built up Berkshire a lot.
The insurance business provides us with float, and float is money that we hold that doesn't belong to us.
The way it works is it has a very large insurance arm that has a lot of money from policyholders. They have to invest it to reap some benefits and make sure that they can pay claims afterwards. Berkshire Hathaway has been ramping that up to the max, buying a lot of insurance companies and using that money, the float, to invest afterwards.
This is actually one of the hottest plays in the investment world right now, with a lot of private equity and alternative asset managers either buying or having relationships with insurers.
While Buffett has been the face of Berkshire Hathaway, he long had a sidekick. both conveniently available as lovingly hand-rendered plushies.
Charlie Munger passed away in 2023, but the dynamic he had with Buffett for many years was one of the main draws of Berkshire. They were a unique pair. If you saw them sitting together at the Berkshire annual meeting, they would banter.
I predict Charlie's going to talk about Costco. Go ahead, Charlie.
Well, Costco, of course, is a...
Munger was fundamental to Buffett's investing thesis. At the start of his career, Buffett was very into this idea of cigar butt investing, in which you would take a company, you'd take one last puff, and you'd get what you could out of it before it sort of faltered. And Charlie was one who really reshaped his thinking into thinking about companies that had a longer term advantage.
He went from buying companies that were, not very famous, like Berkshire Hathaway, a textile mill that was struggling, to taking stakes into Coca-Cola or Bank of America.
Not that this approach is always a sure thing.
One is IBM, when he bought a stake in the early 2010. He said afterwards that it was a big mistake. He didn't see how IBM was about to lose the turn of the industry towards cloud computing.
He also orchestrated the merger of Kraft and Heinz about 10 years ago.
It just hasn't gone to plan. Part of that is down to changing consumer tastes, consumers wanting healthier things. Part of that is down to inflation. And Buffett commented recently that while he didn't think the merger in hindsight was a great idea, he doesn't think that undoing it is going to fix the company's problems.
And lately, Buffett has struggled finding companies he wants to invest in, leaving Berkshire with a record amount of cash.
It is so much easier to make very successful bets when you're managing 100 million, 200 million. He's now got a cash pile that's more than $300 billion.
And finding a place to put that capital to work is getting really difficult. He doesn't like to have money that is sitting around and not earning more money.
Higher interest rates these past few years have turned that cash pile into a nice income generator.
But it is going to get harder and harder to deploy that level of capital the bigger it gets.
So this is the Berkshire Hathaway Greg Abel is inheriting as the company's new CEO. Although sadly, we don't have a plushie of him.
He led Berkshire's energy business for so many years. But it is tricky. Warren Buffett has not only been a very good investor, but he's also pretty charismatic. That's part of the reason that so many investors have always made that trek to Omaha despite the cost, despite the distance.
Abel will also be taking charge at a time when Buffett's hallmark strategy is being tested.
It is tough to be a value investor when what's really lifting the stock market is high growth companies. The tech company's valuation might be really high compared to sort of what the underlying assets are. While Buffett has bet on technology in recent years, his misses on those opportunities will always sort of linger.
The change in leadership also risks reviving a long-standing debate.
A conglomerate is not a thing that has stuck around. We've seen many conglomerates, such as GE, fall apart in recent years and sort of be split up.
Buffett's presence at Berkshire won't be disappearing overnight.
He'll remain as chairman, and I think his influence will still be felt by the company. He's a major shareholder of the firm, and while he's slowly divesting that stake and giving it to his children's foundations, I think his legacy will long be felt.
But Abel will be taking over many of his duties, including the writing of Berkshire's annual letter to shareholders.
This is a big change because Buffett fans have been poring over that letter over the years because it's full of witticisms, investment advice, pearls of wisdom. There's also the fact that he's not going to be taking Q&A at the annual meeting next May in Omaha.
Morning. Welcome to Berkshire Hathaway.
He was talking for 4 to 5 hours every year and taking questions from people that follow him all over the planet. That is going to be a big change because Buffett's personality is unmatched in the investment world.
Coming up, we'll check out 3 hot picks in technology. Our guest thinks the Bank of Canada will be perfectly happy to keep rates unchanged this coming Wednesday. Let's get more now from Andrew Kelvin, head of Canadian and Global Rate Strategy at TD Securities. We got those strong job numbers this morning. You think that'll add to the Bank of Canada's conviction rates should stay unchanged?
I think they were already pretty comfortable with the idea that rates were at an appropriate level. That's something they had said in as many words in October, and since then the data had been mostly pretty decent. With that jobs number this morning, they will be extremely comfortable with the idea that they do not need to ease any further. And in fact, if you look at where markets are pricing the Bank of Canada here, after this morning's job number, markets are starting to expect actually the Bank of Canada to lift rates in the fourth quarter of next year.
Lift rates late in 2026.
I think that's a little bit early, but we do think that the next move will be higher, not lower. We see it as more of a 2027 story, but early in 2027. So I think really the story for the Bank of Canada here is that the Canadian economy is perhaps holding up a little bit better than some had feared under the onslaught of trade disruptions with the United States. Mm-hmm. And with fiscal stimulus on the way in 2026, we did have that somewhat expansive budget from the Liberals recently. We could see the Canadian economy perform a little bit better next year than they did this year.
Are we going to see a big wall of spending from Ottawa? I mean, it takes so long to get projects organized and approvals and all that.
That's really the big question here. If I had one thing that surprised me in that budget, it was the timing of the spending, not the amount of spending. That had been pretty well telegraphed that we were going to see increases of spending to the tune of 1% of GDP per year, which is not unreasonable. I was surprised how much they thought they can get out the door by March 31st.
Of next year.
Of next year, correct, by the end of this fiscal year. It's an open question. Like that is sort of the big risk with fiscal stimulus, or one of the big risks. One question is how effectively can you spend the money? Can you get the money to the parts of the economy that actually helps it generate jobs and prosperity? Just for example, if you're spending money on defense, the part of that is imported isn't really helpful for GDP, and defense is a big line item. Mm-hmm. The other question is, can you get the money out the door? Canada has had issues in the past with procurement, and you can say that you're going to spend extra money on capital projects or something like defense, but if you can't actually line up the contracts, line up the suppliers, get through planning processes efficiently enough, it does dent the impact. Nonetheless, we are comfortable with the idea that the government stimulus will be a net contributor to growth in 2026.
What kind of GDP growth are you expecting for Canada this year and next year? What's the range?
So if you look at this year, it's been extremely uneven. We had not a bad start to the year. It was sort of 2% Q1, dropped negative in Q2 very noticeably. Q3 was quite strong again. If you want to look at sort of the average quarterly growth rates for this year, you're probably going to be looking at something in the neighborhood, sort of between 0.5 and 1 percentage point on average.
On an annualized
basis, yes. Yeah. We are not all producing 1% more every quarter. Next year, we're thinking something in the range of sort of 1.5% annualized growth every quarter makes a lot of sense to us.
So certainly not gangbusters next year.
Not gangbusters, but it's pretty healthy in the context of population growth that's dramatically slowing. That was one of the things we saw in the budget. The government is really leaning into that changing course on immigration that the Trudeau government had sort of plotted late in its tenure there. So if we're going to talk real GDP growth of 1.5%, we're going to talk about zero population growth, like that is pretty healthy on a per capita basis.
Yeah. From a demographic point of view, though, should we be maintaining high levels of immigration? I know that's a very long-term question.
It is a long-term question. Given the sharp acceleration we saw in the sort of late pandemic years, early post-pandemic years, I think it's understandable the government perhaps feels like they need to slow things down to let sort of social capacity, physical infrastructure to catch up. Hospitals, houses, Build Canada Homes is a big priority for this government. It's understandable we're taking a bit of a pause here, but if we want to start talking about even 2027, certainly 2028, 2029, we should be looking economically to have a growing population again, because the one thing we don't want to do is find ourselves 20 years down the road needlessly in a position like you see in Europe, like you see in a place like Japan, where you are now actually confronting very unfavorable demographics. Long-term Canada's ability to grow its population is a positive thing, not a negative one.
It's amazing to me how the wealthy Asian economies, Taiwan, Singapore, Japan, I think South Korea, the birth rate has collapsed. Women in those countries are not having babies.
You see that the rich world over. That really is a thing that you see. You see it in Europe. You see it in Asia. You see it in countries as they go up through the economic spectrum.
It's a money thing, yeah.
As people become wealthier, as people have more ability to sort of plan, and the choice of going to work becomes a little bit more appealing. People tend to choose to have smaller families in aggregate for reasons that I can't. It's really beyond me to figure out why.
It's an interesting
but
one,
it is something we observe sort of consistently across the world.
There is a school of thought, of course, the impossibility of finding a reasonably priced house is one reason people are holding off from having kids.
I think that's a pretty fair comment to make in certainly expensive parts of the world, including large Canadian cities. You don't tend to see that differentiation substantially between sort of the expensive parts of a country and the cheap parts of the country, however.
And so the big imponderable, of course, is renegotiation of the North American trade agreement. If U.S. President Donald Trump goes ballistic, that could disrupt the economy, of course.
Absolutely. Yeah. I think one of the lessons of 2025 is that it's probably worth not overreacting to off-the-cuff, in-the-moment pronouncements around further deterioration in the Canada-U.S. trade relationship. It is a risk, absolutely. If you were to see another significant deterioration in our ability to trade with the United States, that would be a negative for the Canadian economy, unquestionably. Our base case is that we see no further deterioration in that relationship. I'm sure it will be noisy in the process of renegotiating USMCA. Like, that seems like a fairly comfortable assumption for us to make that at some point. There will be a headline that comes out that causes my blood pressure to spike and me to work a few evenings. But if you look at sort of the way the U.S. has approached Canada as a trading partner or a negotiating partner over this year, we still have the USMCA exemptions, which covers the vast majority of trade between Canada and the United States. I would be very, very surprised to see a U.S. administration of any stripe put tariffs on energy imports. Given affordability as a buzzword in the United States today, it would be very difficult for me to imagine a world where the U.S., in part of a trade action, decided to make Canadian oil more expensive or Canadian electricity more expensive.
Yeah. I mean, they have gone after steel and aluminum, but politicians often fetishize metals, I think. They can get their heads around them.
Well, and it's sort of the things that we're seeing as fundamental in building the post-war economy. Steel, smelters, autos, like those were the things that I think the notion of like middle-class prosperity in the 1960s context were built upon. And that seems to be very important in the current administration's thought process.
Maybe these days it's more just ensuring your kids are graduating with good math skills. That's more fundamental.
I think that's an important one too.
Andrew, thanks very much.
Thanks for having me. I appreciate it.
Andrew Kelvin, the head of Canadian and Global Rate Strategy at TD Securities. Plenty more when we come back. A new report projects that Canadian food prices will rise next year, leaving Canada spending almost $1,000 more on their food in 2026. CTV's Abigail Beeman has more on what's driving prices up.
As a new and breastfeeding mom, more expensive food prices mean harder decisions for Valerie in Madison.
Now, even the quantity of food as well, I have to cut a little bit, to have the quality. So you have to cut it because, yes, it's just so expensive.
According to a new report, overall food prices are expected to jump between 4% and 6% next year, leaving a family of four with an annual grocery bill just over $17,570, up almost $1,000 from 2025.
Everything, especially the meat, beef, that sort of thing. So I kind of stay away from that.
She's right. Beef was the biggest driver of high prices, climbing 19% in the first quarter and 7.2% overall.
People are so shocked they pivot towards chicken and pork. We're also expecting prices for both chicken and pork to increase as well.
Other factors impacting food prices are the trade war, the GST holiday, and changes to the temporary foreign worker program.
10.6 million Canadians are food insecure, but those that are missing meals on a daily basis or weekly basis, those are 2.8 million. And so food banks right across the country have risen to the occasion.
Food costs have driven Paul Wang to take transit.
Your choice of gas or the food?
Both the dollar and energy costs have not been an issue of late. We are expecting energy costs to be a driver in 2026.
In addition to the U.S. trade war, the report notes other things to watch next year include the impact of more severe weather events and the new grocery code of conduct, which fully comes into force in January. Abigail Beeman, CTV News, Ottawa.
As 2025 comes to an end, Google has unveiled searches that defined our year. That includes stories that captured the attention of Canadians and personalities who dominated the conversation. CTV's John Venavali Rao breaks down the trends that had Canadians curious.
When it comes to summing up the year that's gone by, what better to look at than the things Canadians Googled in 2025? And one subject came up more than any other: the Blue Jays, who gave us some of the year's most memorable moments, including this Vladimir Guerrero Jr. Grand Slam against New York. And in the category of news and events, these two words were the year's most looked up, followed by Canadian election results, Iran, LA fires, and the Charlie Kirk shooting. As for the person Googled the most, Mark Carney topped the list.
This was an election year, and Canadians were following the election every step of the way.
Serial killer Ed Gein came in second. He was the subject of a Netflix true crime series. When it comes to athletes, 4 of the top 5 Googled were Blue Jays, including rookie Trey Savage, and rounding out the list, Canadian tennis star Victoria Mboko, who at age 18 won the National Bank Open in Montreal. As for searches, starting with what, among the most popular were, what does elbows up mean? What time is the Jays game today? And what does 6-7 mean? A meme that caught on fast with kids and has no fixed meaning, part of its appeal. The top why questions: why is Canada Post on strike? Why did Trudeau resign? And why do baseball players spit? When it comes to the top searched word in pop culture, it was La Boo Boo, a line of plush toys that went viral, followed by Bianca Censori's Grammy dress.
My name is Happy Gilmore.
While the top searched movie was Happy Gilmore 2. And the most Googled song, Golden, from the animated musical K-pop Demon Hunters. A year that had its golden moments as we count down the final weeks to 2026. John Venavali Rao, CTV News, Toronto.
The Economist magazine is out with its word of the year, and it's AI. Wouldn't you know it? The word is from AI. It's slop. That's the word for content that is generated by just using artificial intelligence to churn out generic stuff. Apparently now, if you go searching for health information, you're going to be running into loads of AI-driven drivel. And we've heard about this in the workplace as well. People, when they have to do a presentation or a report, just turn to the old AI. The problem is the recipient or victim has to piece through that stuff. And apparently they even now, for generating bogus social media content, they have so-called slop shops in countries like Pakistan. So slop is the word of the year, according to The Economist. Okay, we've got morning markets coming your way after this.